Welcome back, everybody, to Magnolia on Money, where we discuss everything financial from the economy to retirement. And I'm Ed Cox with Magnolia Wealth. And today I thought we would discuss real estate. I've gotten many questions recently about, real estate and how it's being affected by what the Fed is doing. What are mortgage rates currently? And, how is this filtering down into the real estate market? So I've put together some good information. I really think this will help answer some of these questions, kind of what's happening and how it's affecting not only mortgage rates but new upstart builds and that sort of thing. So let's dive in. All right, so the first screen here is I pulled this from I think Freddie Mac's site, but it shows the 30-year fixed rate mortgage, 15-year fixed rate mortgage, and a 5-to-1 ARM. I really just want to focus on the 30-year mortgage where you can see, and this was as of 11/10 of 2020, so that'd be the end of last week. It shows January where we started with fixed rate mortgage right around 3% national average, and then you can see where we are now, which is a little over 7% on a 30-year fixed rate mortgage. So a really big increase over, the last 11 months. And this is because the Fed is raising rates, and it's starting to trickle down into our mortgage rates. So the other question I get a lot is this going to get as bad as it was in the 80s? A lot of my clients had, their first mortgages were 13%, 15%. But let's go back. I went back to see how far did I have to go back until I reached a point where mortgage rates were where they are currently. And I had to go back. There were some rates in 2007 that were pretty close to that, but I went back in right around July of 2002. It looks like 30-year mortgage rates were hovering around that 7% range at that point. And since then, they've basically been in a decline. And then, of course, here's what we've done this year. So we didn't have to actually go back to the 80s to see 7%. It was actually in 2002 was the first time, previously that I found that mortgage rates, 30-year mortgage rates, were hovering around that 7% range. So it's happened before. It's been, fairly recent. And then we'll see what the Fed continues to do and how high these rates get. We're starting to get some indications that the rate at which the Fed is raising rates is going to slow down. And then if we continue to get some of the inflation numbers that will continue to come down, then hopefully that will subside going into maybe second quarter of next year. So some other good information. So home price and affordability. So we look at U.S. home price growth by city. So we can see Miami, Dallas, Atlanta, Phoenix. Those are all really hot markets, have been, this year. You can see the national home price average has increased 15.8%. And then you can see some other cities down here and where they stack up for the year. So pretty big increase on the year, 15.8% for a home price growth in 1 year is pretty big. Housing affordability index. So as this graph goes down, it gets less affordable. So the higher the number, the more affordable it is. So you can see here, July of 2022, this affordability index was very low, meaning that it was not as affordable to own houses. And we're starting to see that hopefully level off a little bit. We'll see. Credit score at mortgage origination, little interesting here. You can see where it's been, fairly high. I think a lot of that was COVID money that came in and boosted the savings rates and savings accounts of home buyers, which will make your credit score go up along with paying off debt also helps credit score. So that was interesting that credit scores were actually pretty high. Now they're starting to decline a little bit here on the end as we move away from the uh, COVID money that was released. So residential real estate. This is really some of these graphs are really interesting where it shows housing inventories. Y'all, we are still at a very low housing inventory level compared to where we normally would be on average. So that tells you, we're still maybe away from kind of getting back to that normal, um, you know, price, I guess, where prices are a little bit normalized. We can start seeing an uptick, and we want to get closer to this line so things will kind of normalize out. Rental vacancies, of course, have gone way down. People are not. There's a lot of people moving out of their parents' homes that were living with their parents, so they've moved out. That's one of the reasons we've seen this, and then also we've seen housing prices that have become so high, people are turning to rent. Single family housing starts. So this is starting, a new house. We're starting to see that go down. So you're seeing the Feds raising interest rates, as we saw in the previous slides, which are starting to slow down the housing starts. A lot of that has to do with the price of materials, the availability of cash through the loans. And then multifamily housing starts, those are still on the rise a little bit there. So as you can see, housing has been affected a good bit by what the Fed has done this year. They've made borrowing a lot more expensive. They made, getting a loan to pay for a house that is actually costing a lot more this year than it did last year. It's just harder to get, and so we're starting to see new housing starts slow down. So we're going to see how this filters out. We'll check this again in about 6 months and see where we are. But hopefully that'll give you an idea of how what the Fed has done has affected residential housing and mortgage rates on America. So that was the goal of what the Fed is doing. They want to slow this down, and part of that is through the real estate market, which is a big part of our economy. So hope that helped. Y'all have a wonderful, wonderful week, and we'll see you next week. God bless. Take care. Bye-bye.